Japan has recently just held snap elections on the 8th of February, and what this could mean for all investments worldwide. The Prime Minister Sana Takaichi and her Liberal Democratic Party has just won with a landslide with a total of 316 seats out of the 465 seats. Takaichi's agenda is all about massive spending. We're talking 122 trillion yen. That's nearly $800 billion in fiscal stimulus, increasing their defense spending to over 2% of the GDP, tax cuts potentially slashing consumption tax on food from 8% to 0%. Her plan is to keep rates low and to print money to fund this. Normally, this would support the carry trade. Cheap yen, low rates, perfect for borrowing, but the paradox here is her spending is so massive that it's breaking the very system she's trying to maintain. To fund 122 trillion yen in spending, Japan has to issue a flood of new government bonds. Even though the Bank of Japan is going to buy these bonds up, there's simply too many bonds for the market. When private investors look at this, they'll say, you're printing way too much money. I need higher rates to compensate for the inflation risk. So bond yields will rise anyway, and the yen has been continuously collapsing over the past months. The problem here is, as the carry trade unwinds and becomes less profitable, investors are forced to sell risk assets globally. That's why we're seeing deleveraging happening in the moment. In the short term, this might look like intense volatility for a lot of risk assets, especially Bitcoin. But in the long term, it's always massively bullish. As Japan prints more money, it weakens the yen, increases inflation. More money printing, more inflation, more monetary debasement, which is exactly why Bitcoin exists. And Bitcoin actually fixes this problem. Yes, expect volatility in the short term as people de-risk, deleverage, and the carry trade might start to unwind. But if you zoom out and have a long enough time preference, you can see that Japan's election has just proved to us why Bitcoin exists in the first place.